We have a panel of guests, and joining on the show is Gaura Sen Gupta, Chief Economist, IDFC First Bank. We also have with us Rajni Thakur, Chief Economist, L&T Finance, and Rumki Majumdar, Economist, Deloitte, India. First and foremost, let's go to Rumki Majumdar. How do you read the numbers? All right, we'll wait for Rumki Majumdar to join. We have with us Rajni Thakur. How do you read these numbers? It is better than expectation?
It is definitely better than expectation. We and most of the people on street as well were placed for a 7.2, 7.3% kind of a growth number, and at a 7.8, it's definitely very strong. What it gives us is a very strong footing as we enter into the new fiscal year. And also, as our Governor mentioned this morning, we are entering the new year with the strong numbers. And despite the global events that we have facing us, given our initial strength, we've kind of relatively better placed to handle these kind of global events.
Read into these numbers, which are the outliers according to you?
So for me, I think the most major upside was coming from investment numbers. We've seen some very good activities in some of the key sectors as well, like construction and trade. If you recall, hotels and restaurant activities were supposed to be hit. Despite that, in the month of March, when the conflict started, despite that, we are looking at almost 10% growth in the sector. So that's running very strong. Construction sector at around 12% is running very, very strong momentum. And we also see good momentum in investment activities. It's one of the highest in last 12 quarters. So strong investment, strong exports, strong activities in major employment sectors like construction and trade, restaurant, hotels. So overall, it bodes very well for the economic momentum on ground at this point of time, despite the global uncertainties.
Right. Let's also welcome Rumki Majumdar, economist at Deloitte India. Rumki, how do you read the numbers? 7.7% overall in FY26. Were you penciling in these kind of numbers?
Yes, we were optimistic about the FY26, but the numbers turned out to be even better. So, which is a good news, because what it tells us that the economy was very, very strong. And for domestic reasons, because if you look at exports numbers, the numbers are lower than the last year, and it was expected because of the tariff situation that we had. So clearly the growth that we are seeing of 7.7% has been driven by the domestic demand, and not just consumption. It is the gross fixed capital formation, which has been extremely strong. In fact, the highest since the new series has been released. So on the demand side, things have been looking up. But what is even more surprising is the GVA, which is higher than the GDP side, which means the production side of the economy is also held up and better than the demand side of the economy. Manufacturing numbers are very strong, which is a good indicator to say that the economic activity in the manufacturing sector was holding up. We were noticing the capacity utilization to be above 75%, which kind of tells you that there was a lot of manufacturing activity happening. Again, services side has been pointed out that it has done very well. So it was a pretty broad-based growth, both from the supply side and the demand side. So clearly, economy till the crisis hit us, economy was really doing well internally.
All right, so manufacturing sector definitely has emerged as the fastest growing major sector at 10.7%. Let's also welcome Gaura into the show. Gaura, you would have seen the numbers. What is one thing which has surprised you?
So definitely the overall growth number, we didn't expect it to be so high. We were at around 7.4. Our GVA was 7.6. So we did expect that the GVA will exceed GDP because subsidy expenditure zoomed, which you could see from the central government fiscal. And then there was a slowdown in net indirect taxes or product taxes. So GVA was expected to be better than GDP. And in fact, in FY27, that whole subsidy surge and potential slowdown in indirect tax revenue, that theme could continue. So even for FY27, you could see GVA better than GDP. But I guess just the overall strength in the numbers, the fact that we had thought that construction activity will moderate a bit. The high frequency was a bit more mixed for construction activity. Also, the manufacturing sector was along expected lines because the listed company performance is very strong in Q4. So we did expect that the manufacturing side will be resilient. Government expenditure, usually that's the side where most people end up missing, because the track record with actual government expenditure and government services is usually that shows up in the GDP is usually it's less correlation. But this time, we suspect that the government services would have been supported by the fact that state government revenue expenditure had actually picked up in Q4, while the center had moderated. But yes, overall, very good numbers, very strong capital as well as consumption growth, very broad-based growth from both the expenditure and the value-added side. That was just showing that the economy was on a very strong footing before the West Asia shock hit.
Right. I want to come to you once again, Gaura, for mining sector numbers. If you would have seen, do you think it is still better than expectations?
Mining sector numbers, yes. Again, it was quite a good, strong pickup that you were actually beginning to see in the mining sector numbers. Again, it was better than our expectations. And track record is again something that is, it usually links very closely with IIP mining, but it was higher than what we had built in compared to what we saw in IIP sector for the mining activity.
All right, we'll have to take a very short break, so please don't go away, stay with us. We'll be back very shortly. And where India has posted better than expected numbers for FY26. It's at 7.7% if you talk about the whole year, while Q4 numbers have come in at 7.8% with a push which has come in from the manufacturing sector, where the growth has been more than 10%. We have with us eminent panel, Rumki Majumdar. I want to come to you to understand the underlying numbers and particularly about the sectors where the lag has been there. I want to understand from you the agriculture sector where the growth has been in the range of 3%.
Right. So the agri sector has probably underperformed. Usually over the last few years, agri has been the pillar of growth at a time when situations were, especially after the COVID, when situations were not so optimistic. But since last 2 years, agri performance has not been as good. 3.1% seems like lower for sure. And the fact that this was after the point that inflation has been very low. So there's a possibility that the GVA part of the valuation of the agri output was probably much lower because of the inflation of food has come down quite significantly. So that deflator might have actually impacted the growth in the agri sector a lot. But that said, I would say the agri sector going forward might see even a stronger risks, given that we are expecting an El Nino situation starting from July to September, which will impact the Kharif production a lot. So agri sector will likely see a continued challenge going forward. But the fact that other segments of the sectors are doing well, so in a way, it will probably have some cascading impact on the income levels of the agri sector as well. So I think hopefully the rural income holds up better.
Right. Rajni Thakur, I want to understand from you the private consumption growth, which has improved to 7.7%. I know I'm little skeptical to ask this question, but is this evidence of sustained recovery in domestic demand?
So domestic demand at this point of time is running very strong. In fact, that's reflecting in the rural economy for good, I would say, over 6 quarters now. In urban economy, demand has also been picking up over the last 2 to 3 quarters. Agriculture, again, kind of bringing back to the rural consumption story. agricultural output, we have seen bumper output over the last 3 seasons. So there is some bit of base effect that's impacting the agricultural growth that you see. But having said that, the fact on the ground is that we've seen bumpers crop. We have seen good prices and good cash flow in the hands of rural consumers. So consumption demand on the rural side has been running very, very strong, still maintaining very high momentum. And we've not seen any letdown post West Asia crisis as well. And urban that was running weak for good, I would say 4 or 5 quarters, has picked up in last 3 quarters as well. So, both sides, I understand where your skepticism is coming from, and maybe going forward, we might see some hit on it. But at this point of time, we don't see any letdown in the consumption momentum in the economy.
And numbers are at least showing that buoyancy. Gross fixed capital formation has actually grown by 8.2%, and Q4 investment growth has been at 10.8%. Gaura, therefore, I want to ask this question to you. Is private sector capex actually beginning to take off?
There is some signs of improvement, and we started seeing that improvement maybe from Q3 on itself, because capacity utilization levels in the manufacturing sector have been high for a while now. It's averaging above 75% for a while, which basically shows that private sector was not adding capacity, expanding capacity, but they were increasing the utilization to support the output. So the factor which has kept private capex at bay has been the uncertainty. First, you had the trade issue on the export front. Before that, before the GST cuts, we had the problem that urban demand in India had actually been weak. Rural was very strong, but the urban part was on the weaker footing. From Q3, thanks to the the GST cuts, we started seeing a revival even in the urban demand side. So there are some nascent signs that there was some improvement in private capex, but these are very nascent. For example, if you look at bank credit, we saw a pickup in term loans, not just working capital loans. That's always a good sign. If you look at the construction part, there was some improvement in construction activity. But now that we have come into the West Asia crisis, I think again, you shall see that, because of the incredible level of uncertainty on, the crude front, the fact that your freight costs have gone up, the fact that there could be supply side disruptions that can happen across a broad range of raw materials. Again, you can see maybe private capex will remain a bit more tentative. So the recovery in a private capex, the nascent signs that we were seeing towards the end of FY26, in FY27, we could see some tentativeness come back again because the global environment is very, very challenging.
Right, Gaura, Rumki Majumdar, as well as Rajni Thakur, please stay with us because I have to once again take a mandatory break. But don't go away. After the break, we'll discuss what does this fine print tell about the current economic situation. After the Q4 GDP data is out. Gaura, I want to understand from you the scenario after the numbers. Do you think the numbers suggest that the growth engine of India is becoming more broad-based?
At least before the West Asia crisis, yes. It is telling you that rural has done well, urban consumption has done well, and there's also recovery in the capex cycle, which mainly has the support of the center plus states, the capital expenditure, and maybe some nascent signs of recovery on the private sector side. So definitely it is quite broad-based. But I think the Q4 numbers also show you, if you look at just Q4, that the slowdown in manufacturing is a little more pronounced than, let's say, what you see on the services side. Services still clocked almost a 10% growth, while manufacturing it's still at 7%, 7.3 still strong, but it's a bit more moderate compared to what they saw in Q3. So it also shows you that this sort of West Asia crisis, where you see a pickup in input cost pressures for producers, will impact, let's say, manufacturing sector more than services, because manufacturing sector spends a larger share of its expenditure is on raw materials, fuels, while services sector, largest share of their expenditure is on labor. And the burden sharing model in India for now, at least, unlike, let's say, the other developed countries where the consumer has faced the entire brunt of the fuel prices. In India, we have a burden sharing model. Majority of the brunt has been taken by the OMCs and the government of India, and there has been some sharing of burden with the consumers from May onwards. So we still feel the services sector will be still relatively better off than manufacturing in terms of navigating this West Asia crisis from an input cost pressure perspective. And also the fact that merchandise exports will tend to be more impacted rather than the services side, which is held up despite all the AI threats that are there. So just to conclude, services should hold up better than manufacturing in FY27.
All right, now that is something which needs to be watched out for, because in today's monetary policy, governor did announce a lowering of the forecast for FY27. And therefore, Rajni, I want to understand from you, while the forecast is lowered considering what is happening on ground, how much of the green shoots you think this data will provide, or the expectations for FY27 as well?
So let's keep in mind that the Q4 data that we got today had 1/3 of the quarter getting impacted by West Asia crisis, and some of the sectors like ceramic, plastic, paints were immediately impacted. We've seen loss of momentum in some of those specific geographies and specific sectors as well. Having said that, strong place to start with doesn't negate the fact that there are some risk building up. What we understood from RBI's commentary in this morning as well was that, while there are risks building up, we really need to wait and see if these risks are going to persist in the system, or should we look at these risks being temporary and fading out. I mean, if you notice the quarterly path that they've shown for growth and inflation, the worst impact really comes towards Q3 of the fiscal year, October to December quarter. Assuming the base case, which should most likely happen as well, that we see the war or West Asia crisis fading out by then, most likely the inflationary risks that we are talking about, or the impact on consumption or inflation that we are talking about, would have started to fade by Q3 as well, and then we'll see it gradually reverting to what we have today. So hopefully it's a short-lived impact for the next year. 6.6 is the number that RBI has given us for next year. We are working with a 6.5, but there is every possibility that we might have some upsides building up as well if the crisis kind of starts to fade quickly.
Right. Rumki Majumdar, what do you actually take the message from the current numbers which has been released by the government, and especially FY27 guidance? You think there is a scope of revision in the guidance and actually outperforming what we have projected? Of course, a lot depends on Mr. Trump.
Are you talking about the previous year's numbers or the outlook numbers to be revised up?
The outlook numbers, of course, the previous year
numbers.
Yes.
Okay. So we Deloitte is actually quite optimistic. We are penning down a growth of 6.7% because we believe somewhere the situation in the Middle East will probably ease out by, say, July or August, and by then I think. And so far the government has absorbed a lot of the shock so far. So I think by the time it starts cascading, the situation will improve. Of course, we remain very optimistic about the situation that is happening in the Middle East, and so that we are expecting growth to be around 6.5 to 6.8, so around 6.7% growth. Now, there are some risks. One of the biggest risks would be on the inflation side, where we don't know how quickly and how quickly that can pick up. If that happens, then RBI will likely be forced to increase the policy rates, which will again have a cascading impact on the credit growth, which has been extremely strong. So that will have an impact. Credit and given the situation that when we have a currency depreciation and external borrowing is becoming more costlier, a shock of interest rates will probably even impact the credit growth further.
Right, Rumki, sorry to cut you across, but we have Mr. V. Anant Nageshwaran, Chief Economic Advisor, speaking on the GDP numbers. Let's go across and listen to him.
able to minimize the frictions that they encounter in normal circumstances. And in order to facilitate their export growth, these measures have been taken. Further, with respect to ensuring availability of fertilizer for the current Kharif crop season, gas allocation to fertilizer plants, adequate availability, because the opening stock of fertilizers has been more than 50% compared to the usual 33% of the fertilizer usage during the Kharif season. And imports have also been secured from alternative sources. Large global procurements have been undertaken. And there is also attempts to ensure that fertilizer usage is judicious, keeping in mind the supply constraints that we are facing. And sugar exports have been banned just to ensure that enough sugar is available, enough sugarcane is available for ethanol and biofuel production in general. With respect to industry and services sectors, customs duty waiver on 40 petrochemical products, 29 textile and man.
All right, so that was CEAV Anant Nageshwaran detailing the record numbers actually which has been put out by the government. Q4 GDP has come in at 7.8%. It has surprised everyone. With this, it's time for a wrap in this special edition of State of Economy. Keep watching ET Now.